Most retirement portfolios are ticking time bombs if you're following the old school traditional 60-40 strategy. If you're following that strategy, you could be setting yourself up for failure. In this video, I'm going to show you how to build a retirement portfolio that generates reliable income and weathers any potential market storm. By the end of this video, you'll know exactly how to structure your investments for long-term security, growth, and cash flow. Now, first, do me a favor, like this video, subscribe to the channel, and for more helpful tips, follow me on X at Mark Tepper SWP. First, let's address the problem with traditional portfolios. First thing is that the 60-40 portfolio is failing. I've talked about this in other videos, but very simply, a 60-40 portfolio tends to be like the textbook go-to from an asset allocation standpoint for pre-retirees, retirees, and heck, sometimes all investors, because it's just become commonplace for investors to subscribe to this dated, archaic 60-40 asset allocation strategy. Again, that 60-40 strategy means roughly 60% of your portfolio goes in stocks and 40% goes in bonds. Or if we want to generalize it even further, 60% goes into what we can call risk assets. That could be assets where there's a higher potential for return, but the drawdown potential is also greater. So stocks could be an example. Private equity could be an example. Real estate might be an example, depending on the kind of real estate we're talking about. So 60% in risk assets and the other 40% in non-risk or low-risk assets, where it could be bonds or it could be high-yield cash, whatever it may be. So 60% in risk assets, 40% in less risky assets. And this 60-40 portfolio strategy used to be the gold standard. This is something that textbooks have been talking about. Everyone that thinks they've gone to, financial advisor school, this is the strategy that they pitch to their potential clients. And I guess overall, the strategy works if you're just considering simple math distributions in retirement. I don't subscribe to this methodology at all, and I actually think there's much more effective ways for you to be managing your portfolio than to be subscribing to the 60-40 strategy. The 60-40 strategy used to be the gold standard, but in 2022, just a few years ago, the 60-40 portfolio actually had its worst year since 1937. It was down 16%. According to Vanguard. That's quite the drawdown for a portfolio that gets positioned to clients as something that will help them to weather the storm and avoid those severe drawdowns. So even in this 60-40 strategy, what we have learned is that sometimes bonds don't go up a lot when stocks go down. Sometimes they can move in tandem, they can move in lockstep. And what this does is it argues for greater diversification than just a plain vanilla 60-40 strategy. The second problem with traditional retirement portfolios is that retirees underestimate stock market volatility. In a different video, I talk about the average bear market, how long it takes for the market to draw down, how bad the average drawdown is, and how long it takes to recover. And what I informed you about in that video is that the average bear market from top to bottom takes about 11 months or so to get there. It's certainly important for us to keep that in perspective to ensure that we are managing our portfolios and managing our expectations properly. Now, when we talk about volatility in the stock market, the average intra-year drawdown in the stock market, and what I mean by intra-year, that's within a year, the average drawdown is a 14% drawdown. So on average, even in a positive year where the market's up, there is a 14% top to bottom drawdown, which can certainly present some heartache, but also present some opportunities if you are looking to be opportunistic and take advantage of stocks that might be trading at a discount or on sale. So the average intra-year drawdown is 14%. The average bear market drawdown, depending on whether you're in a recession or not in a recession, can easily be 20, 30% or more. So it's really important that we position ourselves accordingly. One of the things we have to be conscious of is we can't sell low. We want to buy low and sell high. So we need to brace ourselves and make sure we keep in perspective the length of time of these bear markets and how market volatility is a normal occurrence in the market. Now, the S&P 500 has had right around 10 or so 20% drops since 2000, including very recently. The question is, what should you do instead of subscribing to this old 60/40 portfolio? And what I want to do for you is I want to break down what I call the Bulletproof Retirement Portfolio. All right, so let's get into talking about this Bulletproof Retirement Portfolio. And from my standpoint, there's really 4 things that we should have as part of this portfolio. The first thing, and it's important that you're building out this Bulletproof Retirement Portfolio prior to any market drawdowns. Don't do this stuff while the market is down 14% or 24%. You want to do this when the market is fine, when it's humming along. So the first thing you should consider doing is you should consider increasing your cash reserves. And cash reserves are essentially dollars that are readily available, they're highly liquid, and there's zero chance of them ever going negative. You should not ever get a negative return on your cash reserves, only positive. And cash reserves could be treasury bills. Sometimes they might be around 3, 4, 5% yield, depending on the market conditions at that point in time. Could be money market funds that could be paying, again, 3, 4, 5%, depending on where we are from a Fed monetary policy standpoint. Could be short-term CDs, maybe where your money's available and you're no further than 30 days from your money or 3 months from your money. So there's certainly a lot of options for you to assemble some cash reserves and still generate 3, 4, 5% on that money. When I say cash reserves, I don't want you to take your money out of your investments and slide it under the mattress and earn zero on it. We want to make sure we're earning something, and it's important that you shop around and identify those specific areas that you want to utilize as your cash reserves. Now, in a different video, I talk about the length of time of bear markets on average. And what I told you is that on average, a bear market from top to bottom until it regains its prior peak, that takes about 1.7 years on average. So if that's true, it would make sense to potentially hold 1.7 years of your spending deficit in cash reserves or safe vehicles. When I say spending deficit, we'll use an example here. Let's assume you need $100,000 a year to live off of, but Social Security, pensions, income sources, whatever it may be, generate $60,000 of that $100,000. You are therefore running a $40,000 cash flow deficit. So that is what you should be covering over the course of 1.7 years. That's what you want to protect for. That's where you want to potentially consider having that amount of money in cash reserves. The second thing you should consider having in your portfolio would be dividend growth stocks. And look, when I say dividend growth stocks, here's what I really mean by that. We're talking about stocks that pay a dividend. There's no requirement that they pay a 3, 4, 5, 6% dividend yield. Just companies that pay a dividend. And when I say growth, these are companies that pay a dividend, but they're also expected, or we expect them to have the ability to grow their earnings, not their dividend, to grow their earnings at least as fast as the broader market, the S&P 500, or hopefully faster than the S&P 500. The great thing about dividend stocks in particular, whether they're dividend growth stocks or not, is that any company that pays a dividend, if you think about it, they're profitable. You can't pay a dividend if you're losing money. So the first thing that does for you when you're building out your portfolio is it ensures that you are buying companies that are profitable. They're not these zombie companies that are making no money. And if you think about it, if you look at the Russell 2000 small cap stocks, I don't have the number in front of me right now, but I believe it's like 30 or 40% of small cap stocks make no money. They actually lose money. So by focusing on dividend payers, we are focusing on companies that are profitable and they're returning some of their profits to shareholders. Beyond that, when you look at dividend paying stocks, historically, dividend paying stocks are less volatile than growthier non-dividend paying stocks. And believe it or not, they've actually outperformed when you count the dividend and you reinvest the dividend. So you go back through history, start, somewhere around maybe the Great Depression or so, and dividend stocks have outperformed non-dividend paying stocks with less volatility. You can also focus on companies that are increasing dividends and things like that, and we can talk about dividend aristocrats in a different video. But I think having some lower volatility, profitable companies in your portfolio that are returning some cash to shareholders is a smart thing to do as you're building out that bulletproof retirement portfolio. The third thing you should consider having would be alternative investments, which can include real estate. It might include private equity, private credit. This is a great sleeve of investments because this sleeve, the alternative sleeve, does not have a direct correlation to stocks or bonds. So it really helps us to further diversify our portfolio. And normally what it will do is it will give us an opportunity to provide or enhance our returns while simultaneously reducing risk because we hold another non-correlated asset class. So typically, what clients like who are in this bulletproof retirement portfolio is maybe 20-ish, maybe even up to 30% of their portfolio in real estate, alternatives, private equity, private credit, or maybe just private deals. Like maybe they're ultra high net worth and they've come across a ranch as an example that they want to buy and develop. So roughly 20 to 30% of the portfolio can fit into this alternative sleeve. Now, when we talk about real estate, there's certainly different subsectors within real estate. There's office space, there's multifamily or apartments, there are warehouses for e-commerce, there's data centers for artificial intelligence. So there's certainly a lot of subcategories within REITs. And within, I guess, the pure alternative slice, whether it is private equity or private credit, certainly some great opportunities there. In fact, a lot of the private credit opportunities that are out there are paying some very, very attractive yields right now. High single digits, maybe even into the low double digits. So certainly worth exploring. Now, the one drawback to alternative investments, real estate, is that they are liquidity constrained. What that means is they're not fully liquid, and if you put $50,000 or $150,000 into one of these investments and you want your money back tomorrow, you're probably not going to get it back tomorrow. So one of the things you need to look at is your options for having your capital returned to you. What is the method? What is the process for doing that? Important for you to pay attention to. And the fourth thing you should consider having as part of this bulletproof retirement portfolio would be low risk bonds. And this maybe could be 10 to 15% or so of your portfolio. And this would obviously consist of treasuries because they're backed by the full faith and credit of the US government, which hopefully the US government continues to honor their debts and pay their debts. But this could be high quality corporate bonds like from Apple or Microsoft. And I gotta tell you, if I were to look at the balance sheet and the P&L statement from Apple or Microsoft, those look a heck of a lot healthier than the P&L and balance sheet of the United States of America. So might not be a bad idea to consider some of those higher quality corporate bonds whereby these are companies that have high profits, they have a lot of cash on the balance sheet, and just a little bit of debt. You can rest assured and sleep at night knowing that you've got your money with some companies that are highly likely to pay you back. The key here is to build a portfolio that grows income, it protects against inflation, it avoids major drawdowns, and it gives you an opportunity to participate in upside returns in the stock market. So now let's talk about how you actually implement this. Before we get into how to implement this in your portfolio, I want you to drop your comment below. And the question I have for you is, as it relates to the alternative investment sleeve we just talked about, do you believe crypto fits that sleeve? Why or why not? Drop your comment below. All right, so the first step you need to take in order for you to build out this bulletproof retirement portfolio is you need to rebalance according to some of the parameters I just shared with you. But you want to do that when the market is humming along. You don't want to do that in the middle of a drawdown, because what will happen if you do it in the middle of a drawdown is you are going to be selling assets while they're low and buying other assets while they're high. The best time to do this is prior to the market selling off, so that you are selling assets while they're high and buying other assets while they're low. Now, this is also something that you want to take a look at, probably if you're within 5 years of retiring and or after retirement. You certainly want to reduce some of your growthier stock exposure. You want to begin to add dividend payers so that you smooth out the roller coaster ride that is the stock market. And you can begin to focus on some assets that are going to provide you with regular, consistent income. The second thing you need to do, again, pre-market sell-off, is you need to look at moving your cash into cash alternatives, if we call it that are actually generating some return for you. Whether it's a high yield savings account, or you might be able to get 3, 4, 5%, or short-term treasuries, or money market funds, or maybe even short-term CDs. Again, you want to do this prior to any market sell-off. The third thing to make sure you're implementing this for yourself is really starting to build that income stream so that you can generate some consistent returns and have income available to you if and when retirement becomes a reality for you. So look, if our goal is to replace roughly 70 to 80% of your pre-retirement income, here's a graphic that shows an example of a $3 million portfolio where we have roughly $1 million in dividend paying stocks at an average 3.5% yield. Personally, I think that might be a little high, but for the purposes of this scenario, let's assume a 3.5% yield, which would kick off $35,000 a year of dividend income. This individual then has $750,000 in REITs, real estate investment trust, that's a REIT, at a 5% yield for $37,500 a year. And then this individual also has $750,000 in bonds and or alternatives with a 4.5% yield, or another $33,750 a year. All of that adds up to $106,000 a year, or $8,800 a month, without ever touching your principal. Not a bad deal. So here's the bottom line. A bulletproof retirement portfolio isn't just about returns. I mean, we're talking about peace of mind and income stability. Super important for a lot of people who are gearing up towards retirement, or maybe even already retired. Now, if you want to see how high net worth retirees structure their portfolios, hit that subscribe button right now, like this video, and let me know in the comments, what is your biggest retirement concern? In the meantime, find me on X at Mark Tepper SWP.